Sometimes you just need to close an option position to lock in profits. After selling a covered call using shares that you have in your portfolio as the collateral, you realize that you'd rather keep those shares, but you still want to lock in profit. Well, in this video, I'm going to show you how to close out your position and still make a profit from the premium payment that you received. You can have real-time notification on my trade alerts, plus direct access to me via my Q&A chat channel. Simply join my Simple Trading Room community by going to discord.simpleoptiontrading.com. I'll see you over there. Sometimes the sellers of a covered call will find themselves in a situation where it's advantageous and or desire to close out the option contract they just sold. Now, the seller may want to keep the shares for any number of different reasons, like they like the stock, so they want to hold on to them, or they want to use the shares for something else, or maybe the seller changes their mind and they're not willing to risk having their shares assigned to the buyer. For example, if the seller likes holding the stock and wants to keep the shares, this is a situation where the market price is rising and the likelihood of the shares being assigned is probable, then the seller will want to close that option contract. Or maybe it's something really simple like the share price is dipping, so it's more likely that the contract will expire worthless, and the seller doesn't want to have to wait for that expiration date. Before I describe the technique to buy to close to lock in profits from a covered call, let me take a few moments to describe the mechanics behind selling a covered call. For the viewers that already understand how covered calls work, go ahead and skip ahead 3 minutes. I'm going to use myself in this example of selling a covered call. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date, and I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now that I showed where a covered call option contract originates from, let me now share a fictitious example and walk you through a covered call option trade. We start off with me on the left and the stock market with buyers on the right. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date, and I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now, once I've done this, I offer it for sale on the stock market, and then an interested buyer will let me know that they want to buy my option contract, and so they're going to be willing to pay the premium for that option contract. So I receive the premium, and the buyer then takes ownership or is retained or is associated with the option contract. At this point, now I have to sit and wait for the expiration date. And now let's skip forward 30 days to the expiration date and look at what happens. It's going to be one of two things. So the first result is the market price finishes above the strike price. So in this case, the option contract is going to be exercised. And so my shares will get assigned to the buyer, and I'm going to receive payment for those shares. And I get to keep the premium. Now, the other result could be that the market price finishes below the strike price, in which case the option contract is going to expire worthless. And I'm going to retain the ownership of those shares, so I don't have to give them up. Plus, I keep the full premium that I received for selling the option contract. So let's now take a look at the two possible results from me selling a covered call option contract. Outcome number 1 occurs when the market price finishes above my strike price, in which case my shares will get assigned to the buyer, and in return I'll receive payment for my shares based upon the strike price. Additionally, I will keep the full premium payment that I received for selling the option contract in the first place. The second outcome happens when the market price finishes below my strike price on or before the expiration date. In this case, the option contract will expire worthless. And as a result, I'll retain ownership of my shares. These are the shares that were reserved as my collateral and allowed me to write the covered call in the first place. Additionally, I'll keep the full premium payment that I received for selling the covered call. Great! Now at this point, we all understand how covered calls work. So let's jump into how to close a covered call by using a real example. Here's a transaction record from my account history where you can see that I sold a covered call. It's for stock symbol AFRM with a $93 strike price and an expiration date of January 28th of 2022. Now I submitted this order on January 12th, and it was filled later that morning at 10:09 a.m. Pacific time. Now at the time I sold this option contract, it was paying $2.15 per share. So when this option contract got filled, I received a total premium payment of $215, which showed up as a credit deposited immediately into my trading account. Here's a daily chart for stock symbol AFRM going back to January 1st of 2022. And you can see that on the date that I sold the covered call option contract, January 12th, the stock closed at $78.79. And since that time, the share price has been getting lower and lower. And on January 20th, 8 days before the expiration, the price closed at $62.80 per share. So with the market price falling and getting more and more distant from my strike price, I decided to close out this option contract by using a buy to close technique, which would result in me releasing the obligation to sell my shares, and I could still capture a portion of the premium payment that I received. Here you can see the price for the covered call option contract is now only 9 cents per share. And my option contract has an expiration date of January 28th, for which I was paid $2.15 per share. I'm currently up $206, which represents just over 95% of the option premium I've collected. So now I'll execute a trade to buy to close this option contract. First, I'll push trade, and then I'll press buy. Next, I'm offering to sell one option contract, and then I'll specify an asking price of 7 cents per share. Now let's review my buy to close order. So you can see here, I'm paying $7 to buy back my one open contract, which will release my collateral and remove my obligation to sell the 100 shares of AFRM for $93 on or before the expiration date. So this order looks good. I submit it, it gets received, and it's placed in the open market ready to be filled. Now let's take a look at the actual transaction record from my account history, where you can see my buy to close order gets filled. So I'm buying back this covered call for stock symbol AFRM that has a $93 strike price and a January 28th, 2022 expiration date. You can see I submitted this order on January 20th, and it was filled that morning at 9:55 a.m. Pacific time. Now at the time this option contract was filled, I had to pay 7 cents per share, which means I paid a total of $7 to buy back this option contract. So at this point, my option contract is closed, and I did that by using a buy to close technique. But let me walk you through all the steps so you can see what happened. I used a simple spreadsheet so it's easier for you to visualize. So on January 11th, 2022, I held 100 shares of Affirm Holdings Incorporated stock symbol AFRM in my account. Now to make things simple, I'm going to show my account balance as 0 and the shares I own as 100. Then on January 12th, I sold a covered call using those shares, and I set the strike price at $93 and an expiration date of January 28th. Now for selling this covered call option contract, I received $215 as the option premium. And so now you see my account balance now goes to $215, but now my shares are placed in a reserve as collateral for this option contract in case it gets exercised. Now as we saw from the chart, the price started dropping, and on January 20th, I decided to buy back my covered call. So I used the buy to close technique, submitted my order, paid $7 when this order was filled to buy back that option contract. So now my new account balance was $208. And as you can see, the shares that were reserved as collateral have now been released and are back in my direct ownership for me to use in any other way that I want. So for the total of 8 days that this transaction was in play, from January 12th to January 20th, I was able to sell a covered call and then buy back my covered call so that I could release the obligation to actually sell my shares, and I still kept over 95% of the profit I earned from the premium payment that I received. This buy to close technique can be used not only for covered calls, but also cash secure puts as well. Let me know in the comments section below if you have ever used a buy to close technique, or if you think you might plan to use a buy to close technique sometime in the future. You can get immediate access to my trade alert notifications by joining my Simple Trading Room community. Be sure to use the special link that I've included in the description below so you can join in on the action. There's one last thing before I end this video. Now, making profits and generating an income from option trading is a great thing, but keep in mind that all gains made from trading are considered income and are subject to applicable tax considerations. So every month, I save a portion of the profits that I earned in order to pay for my federal and state taxes. So please consult with your CPA, licensed financial advisor, and or tax preparer regarding the tax liabilities for your unique situation. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And I also want to wish you good luck and lots of success with all of your trades.